Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. Happy New Year. I hope everybody had a fantastic holiday. Did you miss me? I definitely enjoyed some time off, but I'm not going to lie, it's good to be back behind the microphone. So, I don't know how many of you are runners. I used to be until my knee decided, no. But anyway, if you are a runner, maybe you played another sport, I don't know, like maybe golf. You've probably had the experience where you're in the middle of a race, or if you're playing golf in the middle of a game, and you think, man, I'm doing pretty good out here. You just feel right. You're feeling it. And you know that it's going to be a good race. And then when you get to the finish line, your time was even better than you expected. Or, you get to the 18th hole and you look at your score, it's even better than you expected. It's like, heck yeah. I knew it felt good, but I didn't realize it felt that good. So that's kind of how I feel about gold's year in 2024. I knew it was good as we were going through it, but when you look back at it in retrospect, it's actually even better than I realized. I think anybody who has been paying attention knows that it was a good year for the yellow metal. Heck, even the mainstream financial talking heads had to sit up and take notice. And, these people usually just ignore gold, or when they do talk about it, there's this tone of skepticism and derision and condescension. But like I said, the mainstream even recognized how well gold was doing as we went through 2024. But just how good was gold's performance? Well, let's take a look at the numbers. The gold price rose 26.5% in 2024. And it set several new price records along the way. It was the biggest annual percentage gain since 2010. And think back, that was during the quantitative easing, i.e. money printing years, in the wake of the 2008 financial crisis. Now think about that for a minute. From all accounts, the economy was pretty good last year, right? At least it was in terms of growth and the statistics that the government throws at you. Yeah, we had the inflation issue, but for most of the year, we were told that price inflation was abating. The Fed did cut rates a few times starting in September, but for most of the year, interest rates were relatively high, at least in historical terms. They're much higher than they had been in well over a decade. And the Fed was in the process of shrinking its balance sheet. And yet, we saw this big surge in gold, comparable to the recession and QE years after the 2008 financial crisis. So what I'm getting at is gold charted these big gains, even with what are arguably some pretty significant headwinds. Here are a few more interesting data points. During the sustained rally, gold set 40 new all-time highs based on the afternoon London Bullion Market Association price. And the most recent and the highest was $2,777.80 per ounce. That was back on October 30th, right before the presidential election. Gold also set a record in real terms, cracking the inflation-adjusted price all-time high that was set back in, get this, 1980. So when I'm talking about the real price of an asset, I'm really just referring to its price adjusted for inflation as measured by the CPI. So as price inflation peaked in the late 1970s, the price of gold drove up to $850 an ounce. And so if you take that and inflation adjust it to $2024, gold was around $2,689 per ounce at its 1980 high. In the fall, as I've already mentioned, we saw gold over $2,700 an ounce. So it broke that all-time inflation-adjusted price. And, it's kind of funny because sometimes I'll get people citing that 1980 price and then telling me gold sucks as an inflation hedge. And, I guess if you take that moment in time and just take it in isolation, it seems like a valid argument. But the fact is, gold didn't even stay at that 1980 record for very long. At the time, Federal Reserve Chairman Paul Volcker was aggressively raising interest rates to battle price inflation. In February 1980, the Fed pushed interest rates to 15%, and then in March, they drove them all the way up to 20%. This, by the way, is what a real inflation fight looks like. Anyway, gold quickly fell off that January 1980 high, and by the end of the year, it was back below $600 an ounce in nominal terms, and it continued to trend downward for several years as Volcker's inflation fight bore fruit. So my point is, if you bought gold at any other time than that very few months in late 1979, early 1980, when it was at that high, your investment has outperformed inflation. So yes, gold is a good inflation hedge. And I'll link to an article in the show notes that goes into more details, particularly looking at how gold has done as an inflation hedge in the 21st century. So anyway, that was gold's price performance last year. And, I'm probably not telling you a whole lot that you didn't already know. The real surprise to me is how well gold did compared to other assets. So for most of 2024, people fixated on the stock market, right? I remember around the election, people were using the booming stock market as proof of Biden's economic prowess. Now, of course, it had nothing to do with Biden and everything to do with the promise of a return to easy money. Nevertheless, the stock market did objectively boom last year. It was a great year for stocks. Well, you know what? Gold was better. It's true. The yellow metal actually edged out U.S. stocks to rank first among traditional asset classes. Gold also performed better than U.S. bonds. It performed better than the dollar. It performed better than commodities as a whole. It performed better than global treasuries. And with its huge post-election surge, Bitcoin was the only asset that actually beat out gold. The cryptocurrency price more than doubled, rising 111.5%, most of it after the election of Donald Trump. So, great year for gold, outperformed virtually everything. So why did gold have such a great year? Well, there are a lot of factors. I think one of the biggest was inflation and monetary policy. Gold got a huge boost when the Federal Reserve started hinting that it was going to ease off the inflation fight. And as you'll recall, it started doing that even late in 2023. It took them a while to actually get around to it, but they were hinting at it. And from that point, we started to see this rally in gold and weakness in the dollar as well. Here's the problem. The price inflation is alive and well, right? And I think a lot of people know this, and I think that is driving a segment of investors to continue to hedge against devaluing fiat currencies with gold. Now, I think this is kind of a minor segment. I think most mainstream investors actually believe that the Fed has pretty much won the inflation fight. Inflation is a little bit sticky, but by and large, the Fed has it under control, and the economy is going to glide to the mythical soft landing. And so they've jumped back into the gold market simply because they're eyeballing lower interest rates, and that makes gold more attractive as an investment, as a non-yielding asset. High interest rates tend to create headwinds for gold. And that's kind of interesting because we had relatively high interest rates last year, and yet gold still did well. I think another factor that worked to gold's advantage was the fact that we had sustained and significant central bank gold buying. The final data isn't in yet, but it's clear that 2024 is going to be the third straight year of significant central bank gold accumulation. Through November, the total was already over 800 tons. And, you really can't talk about central bank gold buying without mentioning de-dollarization. A lot of countries are trying to minimize their dependence on the greenback. They watched how aggressively the U.S. and its Western allies sanctioned Russia after the invasion of Ukraine, and how they tried to freeze Russia out of the global economy. Because the world runs on dollars, the U.S. has a lot of leverage, and the U.S. has taken advantage of its position as the issuer of the world reserve currency, and it's used the dollar basically as the billy club. Now, we can debate whether this economic warfare is justified, but regardless, there is blowback, and you need to keep that under consideration. I mean, think about it. If somebody has leverage over you, you're probably going to try to minimize their ability to control you by getting rid of whatever it is that creates that leverage, right? So if countries are worried that the U.S. could pull the dollar rug out from under them, as it did with Russia, wouldn't you expect them to minimize their exposure to those dollars? Well, that's exactly what they're doing. And it's not just a foreign policy aspect either. I think a lot of people are looking at the U.S. and the borrowing and spending addiction in Washington, D.C. They're looking at a $37 trillion national debt and deficits that keep getting bigger and bigger. And they're thinking, maybe I don't want to hold on to a bunch of dollars. An Indian economist summed up the thinking, I think, of a lot of people, telling the Times of India that the reliability of the U.S. dollar has diminished. And he noted that there was a notable decline in confidence in U.S. dollar assets. So that's kind of the mindset we have out there in the world, right? So as they try to get away from dollars, these central banks are turning to gold. Gold is real money. It's recognized as such around the world. There are very few places you can go where people are not going to take gold, right? I mean, pretty much anywhere you go. If you say, hey, I'll pay for that in gold, people are going to go, oh, yeah, I'll take gold. People universally understand gold is money. There's no counterparty risk to gold. So if you have it, there really isn't anything anybody can do to devalue it or freeze it or default on it. So, this has been a big factor in driving the price of gold higher. And Russia has actually used gold very much to its advantage to keep its economy afloat during this time of sanctions. I'll actually link to an article with some details about that in the show notes page. So, yeah, central bank gold buying. And it's interesting, too. I saw a blurb yesterday that in the third quarter, dollar reserves dropped to their lowest level in like 23 years as far as what foreign countries are holding. So this de-dollarization thing is real, and I don't think it's going to shift or flip anytime soon. Now, as we look at factors that drove gold higher, I think there was also a good bit of geopolitical uncertainty last year that certainly helped support the gold market. You had the presidential elections here in the United States, and I think a lot of people really expected it to be a contested election and for the results to drag out for weeks. And I think part of the reason you saw gold sell off so steeply after the election is people were kind of relieved that that transfer of power went without too much of a hitch. But beyond the elections, you also had the escalating conflict in the Middle East. You have the ongoing war in Ukraine. So just a lot of things to make people nervous. And of course, nervous investors tend to turn to gold because it is considered a safe haven. I think one thing that's really interesting is that the first leg of this gold rally, so we're talking in the spring when it really started going up last year, it happened without Western investors really getting in on the action. If you look at the supply and demand dynamics, most of the demand was coming from the East. It was coming from China. It was coming from Japan. It was coming from Korea. All of these Asian countries were just gobbling up gold in a huge way. And this was a lot of investor demand. You just didn't see that in the United States and Europe. So there were a lot of factors that were driving gold forward. But, I guess what I'm getting at here, it was by no means a perfect storm, right? There were still plenty of headwinds for gold. It wasn't like the perfect scenario, and this is a once-in-a-lifetime opportunity. Even with these headwinds, gold still did better than virtually every other asset. So I would be remiss as I discuss this if I did not also mention silver as well. Since silver has remained well below its all-time high, even as gold set multiple price records, a lot of people kind of have this impression that silver has underperformed. And, I'm not saying that's necessarily unfair when you compare it to gold. But objectively, silver didn't do that badly. In fact, it did pretty well. Silver kicked off 2024 at $23.99 per ounce, and it closed out the year at $28.91. So that was a 20.5% gain. So it really didn't lag too much behind gold. So silver's gains weren't quite as beefy as U.S. stocks, but it still outperformed emerging market stocks. It outperformed U.S. bonds. It outperformed commodities as a whole. It outperformed global treasuries. So if you bought silver at the beginning of 2024, you shouldn't be disappointed in how it performed, even though it didn't quite reach the level that you might have expected given the trajectory of gold. And, I think investors are going to want to keep a close eye on silver as we move into this new year. Historically, silver has lagged behind gold in the early stages of a gold run, but then it outperforms the yellow metal in the later stages of the rally. And I do think we're in the early stages of a gold bull run. I'll link to another article in the show notes by an analyst that kind of shows that we're set up for the next leg up in the gold rally. So if we are in the early stages still of the gold bull run, if we're just looking at historical trends, you can expect silver to begin to play catch up and ultimately overtake gold as we move into the deeper part of the gold bull market. There are also several signs that silver is underpriced, given the market dynamics. In the first place, you have the supply and demand dynamics. Most analysts seem to think that we had a record year for industrial demand for silver in 2024. Of course, the final numbers aren't in yet, but that's the projection. And the Silver Institute also projects that there's going to be a fourth straight supply deficit in the silver market. And that simply means there was more silver consumed than was pulled out of the ground or reclaimed through recycling. The market deficit is expected to come in around 182 million ounces. And this is actually in line with the supply shortfall we saw in 2023. According to the Silver Institute, this market deficit is, quote, elevated by historical standards, and it is expected to continue as we move into the next several years. So, you have a situation where more silver is being used than what's being produced. That means that silver demand is having to tap into reserves, and this is bullish for the price. It's just simple supply and demand economics. The gold-silver ratio also indicates that silver is underpriced, at least compared to gold. The current gold-silver ratio is over 88 to 1. So that means it takes over 88 ounces of silver to buy 1 ounce of gold. And this has historically been kind of used to show the relationship in price, and it gives you an idea of how silver is doing compared to gold and vice versa. In the modern era, the gold-silver ratio has averaged between 40 to 1 and 60 to 1. So 88 to 1 is way above that historical average. When the gold-silver ratio gets far above the high end of that average, it tends to return to the mean, and it snaps back with a vengeance. And there's several examples of this. We can go back to 2020 during the pandemic. The gold-silver ratio set a record of 123 to 1 as COVID hysteria gripped the world. And then it plunged to around 60 to 1 as central banks around the world cranked up the money creation machine to cope with the government shutdowns of the economy. So that's just one example. We saw the same kind of phenomenon as we ran through the Great Recession. We saw the gold-silver ratio expand and then snap back. So this is how it has happened in the past. Obviously, they say all the time, the future doesn't necessarily predict, or the past doesn't necessarily predict the future, but it is certainly something to keep in mind. And, I've said this before. I think now is a great opportunity to buy silver. You're buying it at a bargain if you believe these dynamics. So, long and short of it, sum up, gold had a great year. Silver had a pretty good year too. What can we expect as we move into 2025? Well, I don't have a crystal ball, so, don't think I'm fortune telling here, but I do think we can expect the bull run to continue. And I say this because all of the factors that I've mentioned that have driven gold higher and silver higher, they're still in place, right? I don't see any big shifts coming along to make me think, well, there's going to be a lot of headwinds coming into the gold market. Central banks show no sign of ending their buying spree. As I've already talked about, price inflation is still sticky. The Federal Reserve is still going to cut interest rates. We don't know by how much, but I don't think anybody doubts that monetary easing is going to continue. You're still going to have geopolitical risks. There's still plenty of tensions out there in the Middle East, in Europe. So all of the things that have supported the gold market in 2024 and the silver market as well, those things are still in place. They're not going anywhere. And I'd really watch the Federal Reserve closely as we go into this new year. Powell and company are trying to convince you that they're not going to cut interest rates as fast. The projection now is for 2 rate cuts this year. But I think this is mostly posturing. I think they're going to cut more than that because they have to. There is too much debt in this bubble economy to keep interest rates high. I'm convinced that's why they're cutting rates in the first place. Because, if you just look at the inflation data, if you just look at the trajectory of the CPI, the Fed should be holding firm, if not raising interest rates to continue to fight inflation. But the economy is addicted to easy money. The drug pushers over at the Fed can't let their junkie go into withdrawals, and they won't. So that's why I think we're going to see more than 2 rate cuts this year. But you're going to hear the Fed people talking a lot about, holding the line against inflation, et cetera, because that's what they have to do. It's open mouth operations. They're trying to jawbone the markets. But watch what they do. That's really what the important thing is. So, what I'm really getting at here is that the central bank, the Fed, and other central banks globally as well, they're going to create more inflation in 2025, not less. Heck, the money supply is already increasing, and that is, by definition, inflation. So it's likely that we will see that manifest in prices as we move forward. So in my never to be humble opinion, the people selling their inflation hedge right now, they're making a mistake. And I'm not alone in thinking that gold is going to have another solid year. Most mainstream analysts seem to be pretty bullish on precious metals. According to a survey of Wall Street banks and other players in the gold market that was conducted by the Financial Times, gold will continue to post gains in 2025, although the pace of the bull run they think will likely moderate. On average, Wall Street analysts expect gold to gain another 7% in the coming year. So I think if you look at the mainstream projections, your Goldman Sachs, your JP Morgan is expecting $3,000 gold in 2025. It's important to note that these Wall Street analysts almost universally believe the economy is going to glide to the soft landing, right? They don't expect a recession. They don't expect any kind of economic crisis in the coming year. And they expect the Federal Reserve is going to move forward with rate cuts at a relatively modest pace. So these projections of a 7% gain are set in what I would call a Goldilocks scenario, where things kind of continue as they are and everything's fine. Any kind of economic upheaval would drastically change the calculus for gold. If the economy breaks under the pressure of higher interest rates, and if the Fed is forced to speed up the pace of rate cuts, gold is going to get an even bigger boost. In my view, some type of economic chaos is more likely than not in the next 12 to 18 months. We still haven't paid the piper for the monetary malfeasance going all the way back to 2008. We started to almost pay for it back before the pandemic. We were starting to see that shakiness in the economy. The Fed was back to doing quantitative easing, and then the pandemic came and they were able to double down on that monetary malfeasance. We haven't felt the ramifications of that yet. And as a lot of people will tell you, when you have a boom and it's induced by stimulus, the bust is commensurate with the boom. In other words, the bust is as big as the boom. So if that's true, hold on to your hats. And I can't emphasize this enough. The debt-riddled bubble economy is addicted to easy money, and it can't function in a higher interest rate environment. The Fed knows this. But sticky price inflation is also forcing the Fed to at least talk about going slow on easing monetary policy. It's between a rock and a hard place. It's walking a tightrope between letting inflation go and wrecking the economy because it's taken away the easy money drug. And it seems unlikely to me that the central bank is going to be able to manage this balancing act as we go into the future. So if there is a major economic crisis, a recession, a banking crisis, a currency crisis, anything like that, the Federal Reserve is most likely going to slash rates back to zero, and they'll start running quantitative easing again. That's the fork they know. That's what they do. And in this scenario, the price of gold would likely blow through the roof. So yeah, I think it's going to be interesting to see how things play out as we move into this new year. And, speaking of new year, it's often a time for resolutions. How you doing with those resolutions, by the way? Most people end up breaking the resolutions within 2 weeks. But, you don't have to be that person. You can persevere. You can do it. You can set those goals and you can make them. And, maybe you've decided to get your financial house in order for 2025. Gold and silver should be part of that plan, right? If you want to preserve your wealth in a time where fiat currency is depreciating every single day, you're losing purchasing power of your dollar every single day. You want to have gold and silver as part of your portfolio. But if you're like a lot of people right now, you're already probably having a hard time making ends meet because you're dealing with prices going up. I mean, it seems like every single day. And, you might be thinking, well, I don't have thousands of dollars to buy gold. We've got gold at over $2,600 an ounce. It's hard to even buy an ounce of gold. Well, Money Metals has a great program where you can buy gold a little at a time. It's a monthly installment plan. You can do it for as little as $100 a month. And basically you just have an automatic withdrawal every single month. You buy gold at the current spot price at that time, and it allows you to accumulate gold a little bit of time. It's stored in our beautiful brand new bullion depository, bigger than Fort Knox, with all of the security and auditing and all of the things to make you feel good about your investment. If you're interested in doing something like this, you can find out more about our monthly purchase plan. Just call 800-800-1865. Talk to a Money Metals precious metals specialist. You can also go to moneymetals.com and chat with a precious metals specialist online. You can also just go to the link that in our programs, and you can read about our monthly purchase plan. But do it today. You want to start 2025 outright. This is one way to do it and kind of start saving real money. And highly recommend doing it today. And also don't forget about silver. You can also accumulate silver. I mean, why not both, right? So that is a wrap for the first episode of the Money Metals Midweek Memo podcast for 2025. You can get more information about everything that I've talked about on the show today and more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your email box, make sure you sign up, get on our email list. It's the best way to keep up with what's going on out there in the markets. Of course, you can subscribe to the Midweek Memo on your favorite podcasting platform. And then you can also tune into our Market Wrap podcast every Friday, where you'll get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold, silver, economics, and investing. As always, I very much appreciate you taking a little time out of your day to listen to the show. I know there's plenty of stuff out there vying for your attention, lots of stuff to listen to, so thank you for spending a little bit of time with me. I hope you have a fantastic rest of your week, and I will be back here next Wednesday.